Joining me now is Bill Bergman. He is the senior stock analyst at Morningstar handling Berkshire Hathaway. Great to see you, Bill.
Hi, good to see you too.
Okay, so we were chatting last week. Berkshire earnings managed to triple. So does that impress you, or is it just largely due to an easy comp?
Well, an easy comp, and we shouldn't probably expect tripling in their profit every quarter. So no, it doesn't. But they did have a 10% annualized increase in their book value per share, which together with the second quarter, you've got a 40% annualized book value increase, which is a pretty significant gain. Having said that, it was a pretty easy external environment for Berkshire too in the third quarter. You had the improving economy, you had the improving equity markets, you had the improving credit markets, and you had a light catastrophe quarter as well. So you probably shouldn't put too much into the increase that did arrive.
How much of a risk is the catastrophe issue? In other words, if we have a disaster in this coming quarter, how much will that impact? How much of a curb will that be to the next quarter?
Well, with insurance, if you don't take losses, you don't make money in the long run, and Berkshire's well positioned to take any losses that it underwrites. As a consequence, if a catastrophe occurred, I wouldn't put a great deal of stock in it in terms of the impact on Berkshire Hathaway.
As far as the companies in the portfolio, what impressed you? What were you disappointed in, some of the companies?
Well, you had the light catastrophe quarter, but within the overall results, I was looking for a little better results out of their operating subsidiaries. Berkshire has, it's well known for being an insurance and investment juggernaut, but within the overall enterprise, the wholly owned subsidiaries, they've got about 50 very interesting subsidiaries that are pretty economically sensitive. And with a developing economic recovery, I am looking for still a significant increase in the contribution of those entities to the growth in the book value per share at Berkshire. In the third quarter, we got some of that. We got an annualized revenue increase that was a little bit better than it was in the second quarter, together with a little bit better margin, but they're still kind of depressed on that score. And if we get, I'm expecting the economic recovery to continue and a better pop from those subsidiaries in the next couple of quarters.
We know they had trouble with the aircraft leasing business. They're making layoffs there. But what other companies underperformed in your view?
Well, the collection of them is, I don't know if underperform is the right word. It might be natural to expect these kind of companies not quite to respond to the beginning of an economic recovery, and they haven't yet. But down the road, people like Shaw Industries, a carpeting manufacturer. You've got Iscar, a metalworking company. You've got Forest River, a very interesting, small sort of part of the overall Berkshire portfolio, but it gives you a flavor for the economic sensitivity. Forest River is an interesting manufacturer of recreational vehicles, very economically sensitive company. And so you got housing, you got manufacturing, durable goods manufacturing types of entities within the operating subsidiaries. And down the road, I'm expecting that's about half, the operating subsidiaries are about half the overall revenue within the Berkshire Hathaway enterprise. And they're pretty solid performing institutions over the long run. And so, as the economy gains greater credence here in coming quarters, I'm still expecting a recovery to continue. These guys are going to be making a material contribution down the road.
You guys, the other credit agencies, put Berkshire on credit watch negative on the heels of the Burlington Northern announcement. Is that still warranted given the strong earnings?
Well, it's their opinion. We all have different opinions about credit ratings. I don't have a credit rating on Berkshire Hathaway, but I wouldn't reduce my credit rating if I did have one because of that acquisition. After the acquisition, the amount of cash that Berkshire is going to have relative to their loss reserves in the insurance operations, or in terms of the net written premium in their insurance operations, is, granted, it's going to be down, but they had built it up so high relative to other companies prior to the crisis that they've been employing cash in a responsible way, I think, in the last few quarters, and they're still going to have so much cash, $20 billion or so, after the transaction closes. That's still so much relative to their earned premium that this is still somebody that's a rock-solid financial foundation. It's part of their makeup, and it's not going to go away with the Burlington Northern acquisition.
As you know, as part of the earnings statement, Buffett said the credit crisis has abated, which should bolster the firm's earnings potential. You agree with that? Big picture here.
I do. Well, they've underwritten one thing that, Berkshire is known for underwriting discipline, and there's two parts to that. The insurance companies are always careful about not underwriting if the price isn't right, but there's a flip side to that. Underwriting when the price is right and being aggressive in doing so and not necessarily following the crowd. That's what Berkshire did, not just in their insurance operations, but also with respect to these equity derivatives and credit derivatives that they underwrote. They've absorbed a great deal of volatility on that score. That's part of their makeup, their overall insurance makeup, and they did so in the financial markets. And as the credit markets recovered, so too did the contribution of those derivative positions to Berkshire's book value per share gain in the third quarter.